Imagine you've worked hard your entire life, saving $100,000 in a savings account. You check your balance every month, and the number stays the same. You feel safe, secure. But here's the disturbing truth. That money is worth less every single day, and you don't even notice it happening. This is the invisible thief called inflation. While you sleep, while you work, while you live your life, it's quietly eroding the purchasing power of every dollar you've saved. And most people have no idea how much damage it's actually doing. In this video, we're going to expose exactly how inflation steals your wealth, why traditional savings accounts are actually losing you money, and what you can do to protect yourself before it's too late. Let's start with a simple question. What is inflation, really? Most people will tell you it's when prices go up. And that's true, but it's only half the story. The real definition of inflation is the decrease in the purchasing power of your money. It's not that things cost more, it's that your dollars are worth less. Here's a real example that'll make this crystal clear. In 1970, the average cost of a new car was about $3,500. Today, that same type of car costs around $48,000. Did cars suddenly become 13 times better? Not really. Your dollar became 13 times weaker. Let me give you an even more startling example. If your grandparents put $10,000 under their mattress in 1970 and you found it today, you'd have $10,000 in cash. But here's the kicker. That money would only buy what $1,500 could buy back in 1970. You'd have lost 85% of your purchasing power without spending a single penny. This is the insidious nature of inflation. It doesn't announce itself. There's no notification on your phone saying, hey, your savings just lost 3% of their value this year. It happens silently, gradually, and by the time most people realize what's happened, decades of wealth have evaporated. Now let's talk about something your bank really doesn't want you to think too hard about. The difference between nominal interest and real interest. When you put money in a savings account, the bank might advertise a 0.5% interest rate. Sounds safe, right? You're earning something. But here's what they don't tell you in big bold letters. If inflation is running at 3% per year, and you're earning 0.5% in your savings account, you're not actually earning money. You're losing 2.5% of your purchasing power every single year. This is called your real return, and for most traditional savings accounts, it's been negative for years. Let's do the math on a real scenario. Say you have $50,000 saved in a high-yield savings account earning 0.5% annually. After 1 year, you'll have $50,250. You made $250, right? Wrong. If inflation during that year was 3%, the cost of goods and services increased by $1,500 on your original $50,000 worth of purchasing power. So even though your account shows more money, you can actually buy less than you could a year ago. You effectively lost $1,250 in real terms. Now multiply that over 10 years, 20 years, or 30 years. Someone who keeps their life savings in a traditional savings account during a period of sustained inflation is watching their retirement dreams shrink year after year after year. The devastating part? They think they're being responsible. They think they're being safe. Where it gets even worse. Just like compound interest can work for you, compound inflation works against you. And it accelerates over time. Let's look at what happens to $100,000 over different time periods with different inflation rates. At a modest 3% annual inflation rate, which is close to the Federal Reserve's target, your $100,000 loses purchasing power like this. After 10 years, it's worth about $74,000 in today's dollars. After 20 years, it's worth about $55,000. After 30 years, the purchasing power drops to roughly $41,000. You've lost nearly 60% of your wealth without touching the money, without a stock market crash, without a bad investment, just by keeping it safe. But what if inflation runs higher, like it did in 2022 when it hit over 8%? At 5% average inflation, that same $100,000 becomes worth only $23,000 after 30 years. You lose 77% of your purchasing power. This is why financial advisors get so insistent about investing rather than just saving. Because in a world with inflation, not investing is the same as investing in guaranteed losses. And here's something most people don't consider. The official inflation numbers might not even reflect your personal experience. The Consumer Price Index measures a basket of goods, but if you're spending heavily on healthcare, education, or housing, you might be experiencing much higher personal inflation than the official statistics show. Here's something that might make you angry. Inflation functions as a hidden tax. And it's the most regressive tax there is because it hits the poorest people the hardest. Think about it. If you're wealthy, most of your money isn't sitting in cash. Real estate, businesses, or other assets that tend to rise with or ahead of inflation. But if you're working class or middle class, a much larger percentage of your wealth is in cash savings. When inflation runs at 3%, it's like the government reached into everyone's wallet and took 3% of their cash. But they didn't take 3% of everyone's stocks or real estate. They took cash. The thing that working people hold most of. And who benefits? Borrowers. The government is the biggest borrower in existence. When they owe trillions of dollars and inflation runs hot, they get to pay back those debts with cheaper dollars. It's a wealth transfer from savers to borrowers, from the prudent to the indebted, from citizens to government. This is also why some economists argue that governments have an incentive to allow moderate inflation to continue. It reduces the real burden of government debt without the political pain of raising taxes or cutting spending. Meanwhile, your grandmother who saved diligently her whole life and keeps her nest egg in a savings account is quietly being robbed, not by criminals, but by monetary policy. So what can you actually do about this? How do you protect your wealth from this invisible thief? First, understand that some cash savings are necessary. You need an emergency fund. You need liquidity. But that emergency fund should be 3 to 6 months of expenses, not your entire life savings. Beyond that emergency fund, your money needs to be working for you in assets that can keep pace with or exceed inflation. Stocks historically have returned about 10% annually over long periods, well ahead of inflation. Real estate tends to appreciate with inflation since property values and rents typically rise along with the general price level. Treasury inflation-protected securities, or TIPS, are specifically designed to keep pace with inflation. Commodities like gold have been used as inflation hedges for thousands of years. I-bonds from the U.S. Treasury currently adjust their rates based on inflation. Even high-quality corporate bonds typically offer returns that can outpace moderate inflation. The key principle is this: you want to own things, not just hold cash. Cash is a melting ice cube in an inflationary environment. Ownership of productive assets is what preserves and grows wealth. But here's the critical part: you have to start now. The longer you wait, the more purchasing power you lose. Someone who started investing 30 years ago, even with modest returns, is in a vastly better position than someone who kept everything in savings. And if you're thinking, but what about inflation going down? Consider this: the US dollar has lost over 96% of its purchasing power since 1913. There have been brief periods of deflation, but the overwhelming inflation is betting against over a century of monetary history. Here's the bottom line: inflation is not going away. It's a feature of modern monetary systems, not a bug. And while your bank balance might show the same numbers year after year, the real value behind those numbers is shrinking. The good news: you understand how the game is played. You're no longer one of the millions of people who work hard, save diligently, and wonder why they can never seem to get ahead.